Welcome to Consortia Small Business Accountants Increase Financial Position, the Statement of Financial Position or Balance Sheet. By way of introduction, this session introduces the Statement of Financial Position or Balance Sheet. Consortia Small Business Accountants believe it's important for small business owners to have a basic understanding of their Statement of Financial Position, since many of their business decisions are based on their financial position. Your Statement of Financial Position is a financial statement that reports your company's assets, liabilities, and equity at a specific point in time. So if you are wanting to report January's Statement of Financial Position on January 31st, 2025, that's your financial position as of that day. The total of the assets presented equals the sum of the total liabilities and total equity. So the Statement of Financial Position formula is assets equals liabilities plus equity. And that's the reason why they also call it the balance sheet. Assets balance liabilities plus equity. Classified Statement of Financial Position. Your Statement of Financial Position may be classified or unclassified. A classified Statement of Financial Position is classified in the order of liquidity. It distinguishes current assets and current liabilities, that is, short-term assets and liabilities, from other assets and liabilities, that is, long-term assets and liabilities. Because it discloses the components of working capital, that is, current assets minus current liabilities, it is much more useful. Working capital. Working capital is the amount of cash your company has or doesn't have after accounting for its current assets minus current liabilities. It informs you how much money the company has available to pay day-to-day business needs such as employees, suppliers, and others. The formula for working capital, again, is current assets minus current liabilities. And the higher the cash is left over, this formula, the better financial health your organization has. Current assets. Current assets are your company's resources that are converted into cash or used within 1 year. They are also known as short-term or liquid assets and are crucial for the company's short-term liquidity and ability to meet immediate obligations. So your current assets may look something like this. Current assets would include cash and cash equivalents, accounts receivable, inventory, prepaid expenses, and thus your total current assets. Current liabilities are your company's financial obligations due within 1 year. These obligations are paid using your company's current assets. So again, if you look at that portion of your financial statement, you would see current liabilities, which would include accounts payable, accrued expenses, such as accrued salaries, wages, utilities, current, that is, short-term loans, and the current portion of your non-current or long-term loans or debt. And thus, that's your total current liabilities. Non-current assets. Non-current, also known as long-term assets, over a year, are resources a company owns that are expected to provide economic benefits for more than 1 year. These assets are not intended for sale or consumption within the normal course of business operations and are typically used to generate income or support business activities over an extended period of time. So again, if we were to look at your financial statement, you would see under non-current assets, land, buildings, equipment, less accumulated depreciation. Now, as you may know, you don't depreciate land, in this case, only buildings and equipment. And therefore, you would have land, buildings, and equipment less the depreciation. And then you may have some long-term investments. and thus that would be your total non-current assets. Non-current liabilities, also known as long-term liabilities, are your company's financial obligations or debts that are not due within the next year of the business. They are debts expected to be repaid over a longer period of time, in other words, more than 1 year. So again, if we were to look at your non-current liabilities, we might see non-current, that is long-term loans. You would see long-term portion of your non-current debt, and thus your total non-current liabilities. Equity. Equity represents the small business owner or owners' residual interest in the company after liabilities are deducted from assets. So the formula for equity would be assets minus liabilities equals equity. And again, if we were to see the equity section of your financial statement, perhaps it may look something like this: owner's equity, owner's capital account, owner's draw account, owner's year earnings, and thus the total owner's equity. So let's talk about each one of these things. As far as owner's capital, this account reflects the owner's initial investment in the business, plus any subsequent investments, and any cumulative net income or loss from prior years. Owner's draw account. This account tracks the money or assets the owner withdraws from the business for personal use. It's essentially the owner's compensation since they don't receive a salary. Now again, that's for a sole proprietorship. Current year's earnings. This account represents the business's net income or loss for the current accounting period. In some cases, it may be combined with the owner's capital account. Owner's equity, sole proprietorship. So again, if you were a sole proprietorship, this is how you would calculate your owner's equity. You would begin with the prior period's ending balance, plus any proprietor's contributions, minus any proprietor's withdrawals, plus the proprietor's net income, or minus the proprietor's loss. And thus you come to your ending balance, which is your proprietor's equity. Owners, sole proprietor equity notes. For formal external financial statements, the owner's capital account is typically the only one shown on the balance sheet. For tax purposes, the business income is passed through to the owner's personal income tax return. Owner's equity represents the book value of the business, not its market value. So what we're trying to say here then is we say for formal external financial statements. In other words, if you're wanting to get a loan, and so you have to give them externally to an external person to review your financial statements. In a case like that, you don't break it down between your beginning equity, your contributions, your distributions, your income or loss. You would just break it down as owner's capital account. For tax purposes, the business income, and again, since this is a sole proprietorship, in most cases, whatever the income or loss is passed through. In other words, for example, if you're a true sole proprietorship, you're going to file your 1040 return, and you would then put your business income on your Schedule C. So once this is done, that's the amount you put on your Schedule C. Owner's equity represents the book value of the business. So again, the book value is one thing. But as you know, when it comes to selling, for example, if you're wanting to sell your business, you don't always sell it at book value because there's always many other things involved. A good example would say, I had a piece of equipment. It cost me $100,000. I had it for 2 years. I had depreciated $20,000. So the book would say, okay, then that means that you have $80,000. That's what you should get for it. But that may or may not be the market value. It may be higher or it may be lower. Owners or the partner's equity, a partnership. So we've seen a sole proprietorship. Now we're going to talk about a partnership. And notice the similarity, but there are differences. Because here you have to account for each partner. Each partner has their own account. So again, if you were looking at it, it would say, and this is a two-partner partnership, owner's equity would be, let's say, Smith, capital account, Smith's draw account, Smith's current year earnings. And then you'd have the second partner, Jones' capital account, again as beginning, Jones' draw account, Jones' portion of the current year earnings. And thus, of course, the beginning and end would obviously be the total, but this way you could see how much each one of them, obviously, their balances are. So as far as owner's partner's equity, again, the same formula. You begin with the prior period's ending balance, plus the partner's contributions, plus the partner's share of net income, or minus the partner's share of the loss, minus a partner's withdrawals, and then you'd have an ending balance. You may find there will be different amounts. For example, one partner may make different contributions, another partner may get different or take out different withdrawals. It may not be a 50-50 arrangement. It may be that it's 20-80 or whatever the case may be. So all these things would apply. So now let's look at owner's equity as an S corporation. So now we have the shareholder's equity. So therefore we start with our capital stock, typically the actual amount we paid for the stock when we started in the organization, plus any additional paid-in capital, and then of course the shareholder distributions would be taken away, and then of course the retained earnings, and that would give you your shareholder equity. Now again, let's talk about each one of these. So as far as capital stock, this account represents the par value or face value. So let's say the share said $10 a share, okay? Then that's obviously what you would record, the face value of the shares issued by the S corporation. It reflects the initial investment made by the shareholders when they purchased the stock. Additional paid-in capital. This account records the amount shareholders paid for the stock that exceeds the par value. For example, if a share with a par value of $1 is sold for 10, so the $1 would of course go to the share, whereas the additional $9 will be recorded in this account, the paid-in capital account. As far as retained earnings, this account holds the accumulated profits of the S corporation that have not been distributed to their shareholders as dividends, which S corps generally do not issue. S corps generally do not issue dividends. Usually it's larger corporations that do that. It increases with net income and decreases with net losses and distributions. Shareholder distributions. This account tracks the distributions made to shareholders, which are non-dividend payments from the corporation's earnings. These distributions reduce the shareholders' basis in the S corporation. Owner's equity, again, S corp, as far as how it's calculated. As far as the beginning balance, the prior period's ending balance, plus shareholders' contributions, minus shareholders' withdrawals, plus shareholders' share of the net income, or minus the loss. And then again, that's how we derive our ending balance. S corporation bottom line. S corporation equity accounts provide a detailed record of the financial relationship between the corporation and its owners, reflecting their investments, withdrawals, and the corporation's accumulated profits and losses. As far as statement of financial position, why do we use it? Why is it valuable for us? Number one, it helps us to determine risk. And I should also say, we've talked about external. And so in other words, for example, if I were looking for somebody to invest in my company, that would be an external capital. If I was looking for obtaining a loan, from the SBA or the bank or whatever the case may be, that would be external. Okay. So the point is that when you talk about determining risk, yes, absolutely, the owner should know the risk their company faces at this any given time. But of course, at the same time, there's also external individuals, capital investment typically, that also are concerned about your risk. If the bank made a loan to you, typically you not only have to show them financial statements to get the loan, but you may also be required to show them annually, depending on the type of loan you got. Number two is to secure capital, as we just talked about. So if I'm wanting to obtain a contribution, an investor, or if I were wanting to obtain a loan, obviously I would use the statement of financial position to show that the risk is minimal, okay, and that I deserve the loan. So it helps me secure my capital. Three, determine working capital. Working capital is so essential. That little formula lets you know really where you are at any given month, quarter, or year. Do I have enough current assets, liquid assets, to sustain the next obligations within the next year? And then as far as determining liquidity, that is how easily and quickly an asset can be converted into cash. For example, cash is already liquid. But then as we talked about, the next would be accounts receivable. Well, it's how much people owe us, but the question is, when are they going to pay us? So that's the question. And will they pay us is the other question. Okay. So liquidity obviously is very, very important. And as far as converting things to cash. Number five, determine solvency, or the ability to meet its long-term financial obligations. So working capital is essential from the day-to-day paying our bills, but obviously we may have long-term obligations that we also have to meet. And so will we have, or do we have the solvency to be able to meet those long-term financial obligations? And six, determine the overall financial health. So as I've mentioned to you before, we're going to talk about the four primary financial statements. Today we talked about the balance sheet. We'll then talk about the income statement, and then we'll also talk about the statement of changes in owner's equity, and then we'll also talk about the statement of changes, in cash flow. And so the important thing is that this is 1/4 of what is to tell us a story, and again, it tells us their side of the story. Whereas again, the income statement, as far as profitability, will tell us another story, give us another side. The statement of cash flows will give us another side. And then, of course, the statement of changes in owner's equity will give us another side. So when you're looking at all of these things, risk, securing capital, determining working capital, determining liquidity, solvency, financial health, all of these statements are essential to helping us make this overall conclusion as far as the overall financial health of our organization. Thank you for attending. I hope this has been helpful. Look forward to talking to you when we talk about the income statement. Have a good day.